Hi, this is Aldo Lagruto from the Technical Analysis Institute with another very exciting video. In this one, we're going to cover candlesticks, and we're going to also cover a very cool setup that will help you a lot. So if you like the video, then please subscribe to our channel and don't forget to like it.
One of the greatest aids we have to help us decipher the behavior of the market are candle patterns. Candlestick signals generally pinpoint reversals in trends. As you may know, these candlesticks are known as Japanese candlesticks. The signal system was developed by Japanese rice traders over a period of 400 years. So it is pretty reliable as long as we learn how to use them and identify them correctly. But surely it is not 100%. Nothing in trading is 100%. However, it may increase your edge substantially. The reason why they are called candles is because the bodies and the wicks look very much like candles. You may recall from a previous lesson that candles have a body that represents the range between the sessions open and close, and we agreed to use the most common colors, green and red. When the body of a candle is red, it means that the close of the session was lower than the open. If the body is green, it shows the close was higher than the open. The thin lines above and below the body of the candles are the shadows, as the shadows of a real body. The extreme of the upper shadow is the high of the session, and the lower shadow or tail is the low of the session. Sometimes prices close at the very extreme of the body, and so there is no upper shadow. Those candles without upper shadow are called shaven head, and the ones with no lower shadows are called shaven bottom. There are around a dozen major signals and many more minor candlestick signals. However, in this course we are going to use the ones I have found to be more useful, at least easy to learn, and applicable to pick profitable trades without having to become a master analyst. I want to begin with one of the simplest patterns because it uses just one candle instead of many, so I'm referring to what is called the shooting star. Another reason to start with a shooting star is because it is considered to be one of the 10 major signals of candlestick analysis. It is found at the top of a trend. The problem is, how do we know that we have actually reached the top of a trend? In order to do that, we use the shooting star signal together with the stochastic oscillator. If the stochastic is already in the overbought zone or has made a negative divergence, then we can consider the shooting star signal as valid. Just as a quick reminder, we consider overbought when the stochastic is above the 80 reference line and oversold when it is below the 20 reference line. I hope you do remember that the lessons and assignments in Trading Made Easy build upon the previous ones. So you must make sure you have fully understood every lesson before continuing on to the next. Otherwise, trading will become for you what it is for 99 out of every 100 traders. Something very difficult, if not impossible to do successfully and effortlessly. For most people, trading is frustrating, but it doesn't have to be. Basically, the picture of a shooting star is a bunch of candlesticks making higher highs that end with a big wick to the upside. You can see on this chart, this is the Euro USD, how we have candles here, green candles going higher, producing higher highs, until we get this candle that produces a much higher high, yet it closed on the low of the session and produces a small body here. Okay, the important detail to be considered here is that the upper shadow should be at least 2 times larger than the real body. This would be the real body, and we need an upper shadow that is twice as big. The longer the wick, the higher the potential. The color of the candle In other words, the color of the real body of the candle doesn't really matter. It could be a green candle and still work. It could be a red candle. The fact is that prices were going higher, and at some point the market rejected those higher prices and pushed them down, leaving behind a long upper shadow. There could be a tiny tail, or, like in this case, no tail at all. The main thing is the large upper shadow. To say in different ways, bears took control of the market at that point and brought the prices back down at the end of that trading period represented by the candle. In other words, if it happens on a daily chart like this one, it means at the end of the day, the sellers push the price down. If it happens at the end of a 60-minute chart, it means that the sellers were in control at the end of that period, in this case, an hour. The signal becomes even better if the next candle opens lower. That should be your confirmation. So you can see that here, how this candle opened almost at the same level, but it's also a red candle went down, and you can see they pushed down thereafter. That was a substantial decline that went from 115 all the way down to almost 106. Let's look at another example. On this chart of the USD Swiss franc, you can see the market's going up for quite a long time. It's actually making higher highs and higher lows. Here, these candles are making higher highs. They all become higher, higher, higher until this candle makes the highest high of them all and then closes on the low, producing a very small body in comparison to the upper shadow. And then the next candle that works as a confirmation opens below it and continues lower. And you can see the tremendous decline that that signal by itself gave. Right? So, obviously, the signal becomes correct when we have the stochastic combination. Right here, for instance, we can see how the signal here was accompanied by a crossing of the stochastic as well as divergence, because this high here was lower than this high here, and you can see the stochastic here did not confirm the higher price here. The stochastic was moving lower, and thereafter not only the stochastic lines closed, but they closed the 20th reference line as well. In the previous example we were discussing, you can see how the stochastic also confirmed the signal by giving us a crossing of the lines of the stochastic that both cross the 80 reference line to the downside. Again, another confirmation. Here we have another example in the pound where we can see how prices were going higher, 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 produce another high and a very small body there with a big upper shadow to the upside. And then you can see that the stochastic crossed and the two lines cross the 80 reference line, confirming that beautiful signal of the shooting star, producing a tremendous decline. And on this same chart, we can see another example here. Markets started moving higher again, and look what happened. The higher of that move ended with a very small body. Notice that in this case the body is green, in this case the body is red, but the color of the body does not really matter. Now in this particular case we can see that that was accompanied not only by the crossing of the two lines of stochastic, but also by divergence. Notice how this high here is higher than this one, whereas the stochastic does not confirm that, producing a lower high here than this one. So we have a bearish divergence here accompanied by the shooting star. That by itself is a great signal. So now how we can take advantage of this? Well, we can take advantage in two ways. First, of course, if we are in a long position and we see a shooting star, we may want to exit it, right? Because we know that signal is warning that lower prices are ahead. So if we were long here, we probably would be exiting our position once we see that shooting star. The other possibility is that if we are not in a position, then we can sell this pattern. And to sell this pattern does not require anything particular. You just need the confirmation of the stochastic. Okay, if the stochastic is not confirming it, you don't want to take it. The confirmation of the stochastic is with any of the selling signals of the stochastic that we previously discussed in the previous lesson. And ideally, you want to see that the next candle opens below the body of the shooting star, and your stop would be the extreme of the shooting star. That's basically it. So now your homework. Your homework is piling up because you now have accumulated a lot of knowledge, you have accumulated more signals, and you have accumulated a lot more trading tools. So the first homework is to identify shooting stars in your charts using different time frames. They will appear in 1 minute chart as well as 5 minute chart, 10 minute chart, 60 minute chart, daily chart, weekly chart. It doesn't matter. The time frame is irrelevant. They will appear in all of them. The next thing will be to verify that those signals were validated or confirmed with an stochastic sell signal. Then take trades in your sim, always in your sim, using the shooting star signal confirmed with the stochastic. And so continue taking trades based on the support and resistance areas in conjunction with the stochastic signals, and often in conjunction with the shooting stars as well. You can see how this shooting star here was reaching a level of previous resistance. So if you identify those levels of resistance that come all the way from here, all that resistance was precisely what stopped the prices here, send prices down, and produce a shooting star signal and a tremendous decline thereafter. You can see the decline went from 201.39 all the way down to 1745. So a huge decline. Okay, so remember, in trading, nothing is 100%. That is why we look for trades when we have several indications of having the edge piling up in our favor. So use all the tools you have learned so far to take better and more profitable trades.